Well, I think the most important thing that he'll say is I think he will hint very strongly that the Federal Reserve is going to move to what's known as average inflation targeting. And what that means is the Federal Reserve does want to achieve about a 2% inflation rate, but they're actually willing to allow the inflation rate to run hotter than that, over 2%, like 2.5% perhaps, for a few years, just so inflation expectations come back up. Because the problem is the Fed keeps on saying we'll get a 2% inflation and they undershoot it. So they feel like they have to overshoot it now for a few years to get back to sort of an expectation of 2%. But that really means a very expansionary monetary policy for a while. And I do think that with very strong fiscal policy, a lot of government spending, the US will be able to achieve that. So I think we're looking at higher inflation down the road from a very dovish Federal Reserve.
And many analysts believe that that would open more downside risk and would be dollar negative?
Yes, I think it will be dollar negative at some stage, because I do think that people doubt whether the US will get inflation to rise, but I think I think inflation will rise. So we'll have a situation where inflation's going up. The Federal Reserve is also really trying to keep short-term interest rates very low for a long time. So that's not a terribly good combination for the dollar: rising inflation and very low short-term interest rates. So I do think that could contribute to a continuing decline in the dollar. But the dollar is overvalued for a number of reasons here. This is just one more.
And David, we've had some pretty mixed economic data out of the US recently. Home building looking very positive indeed, but at the same time, we've got a very mixed picture on a week-by-week basis for jobs and jobless claims. How much store are you putting by the weekly data at the moment? Because it's a very stop-start picture. Are you looking at any other kinds of high-frequency data?
Yes, we're looking at a lot of high-frequency data. We're looking at credit card volumes. We're looking at information from the hotel industry, the airline industry, from the car industry. And so what we're seeing is there is part of the economy which involves leisure, entertainment, travel, restaurants, retail, or traditional retail, which is really still in very bad shape. And there are millions of workers who are over 10 million workers claiming unemployment benefits every week. It's going to be very hard to reemploy them. So there's one segment of the economy that's in really bad shape, and it's not going to recover in a significant way until we have a vaccine.